Welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. Joined today by Dave Nadig, Managing Director at ETF.com. Tim Seymour is the founder and CIO of Seymour Asset Management. Will Rhind is founder and CEO over at GraniteShares. We're just a few weeks away from the end of 2019, and it's been a banner year for ETFs. You might be wondering what ETF broke out or had the biggest impacts on market this year. Dave, any thoughts from you here? Your ETF of the year, and when I say ETF of the year, I don't mean the one that's outperformed. I mean the one that you think has been impactful on the market or that came out of nowhere and got attention.
Well, you know, we've been talking about ESG for years here, and this year we finally saw some breakout flows. I will highlight the iShares SUSL. It's the MSCI ESG Leaders Fund. It's pulled in over $1.5 billion since it launched in May. I think that took a lot of people by surprise. I think ESG is here to stay, and people will stop snickering about it.
I agree. ESG, after years, finally broke out this year and is a topic of conversation.
Well, I think it's really interesting because for the retail investor, for the self-directed high net worth, for the advisor, you want to follow what institutions are doing. If you're a big pension fund, ESG is your mandate now. Yeah. You have no choice but to be adherent. And I think I think these ETFs are going to continue to outperform. We've all heard about what's going on in the oil and gas sector and what companies are going to have to adhere to by 2021, 2022. So I like the call.
And your choice ETF of the year, you want to?
This isn't too novel, but I think semiconductors, so the SMH, were so important to really getting the pulse of the market and the dynamic with the trade war. The cyclicality of semiconductors are clearly always at risk when you're, like we were talking about recessionary headwinds in the United States 4 or 5 months ago. And I think the fact that semiconductors outperformed, they were very resilient. They also showed that enterprise spend and that the cyclicality of the chips business may actually be supportive right now to the global economy.
You like it better than tech, because XLK obviously had a great year as well. A lot of tech funds had great years, but you like the semis specifically.
I like the semis because, again, when you look at what are the things that may be getting back to the bottom of the cycle here. So if you look at DRAM prices, if you look at NAND inventories, I actually think that this could even be a decent harbinger for 2020.
Will, you thoughts, ETF of the year, anything make an impact on you that surprised you or you thought was important?
Yeah, I think if you're talking about impactful, sometimes impactful is not always just about raw performance in the market. I would actually think about impactful being what ETF got the most outsized coverage in the year. And to me, that was the Bitcoin ETF. The Bitcoin ETF didn't even happen or doesn't even exist. And we're still waiting for that, of course. But I think an ETF that just sucked up a huge amount of oxygen, huge amount of torque, but obviously never actually made it to market.
Yeah, I agree on your choice on the ESG. What surprised me was minimum volatility and attention it got, because to me, owning utilities and Pepsi and Coke and McDonald's, which are all minimum volatility, not very interesting, and yet it garnered an enormous amount of attention as people were very defensive oriented in the middle of the year. So USMV, SPLV, they are rivals, they have a slightly different methodology, but that would be my vote for impactful. Let's talk about surprises for 2020. Let's put on the crystal ball here. What do you think is going to be important?
We're finally going to get these non-transparent or periodically disclosed ETFs coming out, actively managed, but you don't see the daily disclosures on them. We'll see a bunch of them launch, I'm predicting, in the first quarter. I think what the surprise will be is there'll be a surprising amount of money in these funds out of the gate. I think you'll see institutions show up to play for real. I wouldn't be surprised to see a couple of $500 million funds this time next year.
Can I ask a dumb question?
Yeah.
Go ahead.
What's a non-transparent ETF?
So a non-transparent ETF is just one that's not showing you its full portfolio every single day. And that's really a key thing for a lot of active managers who have stayed out of the ETF space because they don't want to show their book. That's really it.
Makes a lot of sense.
Okay, what else? Surprises for you?
Surprises for me would be things that I think there's been a fundamental call on this many different times. Emerging markets are one place where the EPS, you're supposed to be getting growth out of emerging markets. If you're an investor, the reason you invest in emerging markets is you want some growth premium to deal with the risk premium. I think we're finally going to get a 5 or 6% EPS surplus over developed markets. I also think that miners, and if you look at the basing we've seen in a lot of the core commodities, and I think we've seen a basing in interest rates. I think the trade dynamics are part of this. So I think an XME, which has a Freeport and a lot of steel companies, also has a lot of room to rally.
Non-transparent, huh?
Non-transparent, semi-transparent, periodically disclosed.
By the way, those are kind of naughty words typically.
I know.
Non-transparent.
I've spent my whole career fighting for
fractional
transparency.
shares, for example, Will? I mean, that got a big, a lot of people feel ETFs have been held back by the fractional share issue, particularly in the 401k space. Can that change in 2020?
Yeah, I think it could be. I mean, fractional shares has always been a part of the 401k argument. In other words, proliferation of ETFs and 401k plans. In order to buy a lot of those, you need fractional shares. I think fractional shares also means, with the advent of commission-free trading, we might see more direct indexing, more products in the market that maybe get rid of some of the core ETFs altogether.
Yeah, totally agree with that. I think seeing somebody like Schwab, they'd be the obvious people to come to market. They've already got the technology baked here. They've talked publicly about their interest in direct indexing, about their interest in fractional share trading. They led the market after Interactive Brokers on the no commission trading. So I think Schwab is the one to watch.
Okay, let's keep an eye on that. Now let's talk a little bit about what investors should be buying heading into the new year. So do you expect any ETFs to break out in 2020? What's going to be a breakout ETF?
Well,
what's going to surprise people?
I think it's going to be something like an OIH, because
oil services.
Very contrarian.
I love that call. I love it. Go ahead.
I mean,
say why.
Think about the underperformance we've had. So just in terms of, we're probably at a 3 standard deviation move relative to the S&P, the underperformance. You've got some of the. You've got AAA rated companies, you've got A-rated companies, I should say, in Schlumberger, Halliburton, some of the big oil services companies. But we're finally seeing rig counts start to make a move. We're seeing offshore spending on oil and upstream is starting to improve. I think it's not just Saudi Aramco IPO, but I think you've started to see some working through of base oil prices. I think it's a place where the companies are finally making money again.
Any surprises? Any breakouts that you think are going to happen in 2020?
Yeah, I think if we get a correction or something happens to the market, people will look for defensive names. Something like gold, I think will come back in a big way. There's obviously been a lot of interest in that, but right now with the market still doing well, people are still focused on pro-cyclical, market-based strategies, and I think that if there is a pullback or some correction, you could get gold coming back.
And you still like emerging markets too. I know you brought that up earlier.
Well, they kind of go with gold. They kind of go with miners. They kind of go with oil services. But it comes down to having some opportunity. If you think about the EEM, 40% of that is China, right? In 2019, the renminbi was a major headwind. But 45% of Asia's GDP is pegged to the renminbi. I think, especially in a world where we get a trade deal, dollar weakens a bit, takes a lot of pressure off of the Asian currencies. And EM, if you think about the top weights in there, you've got Samsung, you've got Tencent, you've got Alibaba. Alibaba is breaking out over a multi-year range, and I think the fundamentals are very strong there.
It's a very smart move to dual list it in Hong Kong. Yeah. Ever since they announced that, it's been moving up. I don't know, what, 2% of the volume is wagging 98% of the dog.
Yeah.
It's amazing. There's a lot of retail people, 600 million.
It was 40 times oversubscribed in that local listing 3 weeks ago.
Bananas.
To the local
ridiculously small float.
I'll take a bit of a flyer here. I think this is going to be a big year for cannabis ETFs. I'm not going to pick one. No, I'm serious. So look, we've had a lot of we've talked a lot about it, but it's been a rough year for most of the cannabis investments. And I think that in 2020 we're going to see a continued push towards legalization around the world. The companies that are in these funds right now, I think, are going to get overpriced very quickly, and we're going to see a lot more companies come to play.
Here's how I can support David without being, as a guy who runs the cannabis ETF, full disclosure.
Yeah, thanks for bringing that up.
No, but it's important because, my view is that the size of the addressable market has grown. I just came back from 3 days at the MJ Biz, the industry conference. The companies themselves, you're starting to see separation of the performers and the non-performers. You're starting to see capital markets dynamics come to work. So there's no question about the efficacy, what's happening in the sector. The question is, are these companies right now you can invest in?
Okay, let's move on here. One of the more interesting ETFs that launched this year seeks to exclude losers. Instead of trying to pick the winners, X out, X-O-U-T, get it? From GraniteShares flips the investing paradigm by identifying companies that are likely to underperform and excludes them from the portfolio. Will, you're the firm behind this idea. What have you back-tested this idea? It's interesting. I'm not sure I buy into it, but it's an interesting thought.
Yeah, no, it's back-tested, and like all good back-tests, there's never a bad one. I think,
well done.
I was just thinking about it when Tim was talking about cannabis, and again, this is sort of, in some ways, what's happening to the whole industry, right? We had the index 1.0, where somebody puts out an index to represent a particular theme or a market more broadly. Yeah. And we've all been used to this idea that, hey, we buy the market and we buy every company in the market, regardless of whether it's good or bad. And what's happening in cannabis, separation of good companies versus bad companies, is the same thing that happens in the market, which is there are good companies that will outperform over time, and there are bad companies.
All right,
so why not get rid of the bad companies and keep the good?
Of course, it sounds great. What's in this thing? How many stocks are in it?
So what we do is take the 500 largest US stocks by market cap and exclude 250, so half of them that the index deems most likely to underperform. So you end up with a basket of 250 companies, and those are the companies.
And the underperformers, you're doing like momentum. What are you doing to pull them out?
How are you measuring underperformance?
Yeah, it's not factor-based. It's fundamental metrics. So we take 7 fundamental metrics and blend them together to create a score. So we score every company and then get rid of the 250 most likely to underperform.
Do you end up with big sector tilts here? Because I could imagine, for instance, you might exclude a ton of energy companies based on fundamentals and end up loaded up on tech stocks. We just saw some of the top holdings there, Facebook and Alphabet.
And the second part of that question is, are you agnostic? In other words, do you care if you're totally mismatched? Because not owning energy over the last couple of years, which is only 4% of the S&P, has actually been a good thing for PMs.
So we don't care. The model doesn't care. It's about separating good companies from bad companies. To Dave's
whatever
point,
the sector tilts are, the sector tilts are.
Exactly. So right now there'll be a slightly higher weighting towards tech, for example, than in the broad market.
Pretty heavy. It's a FANG. I mean, that's a FANG. Large.
And you'll exclude sectors such as, or at least a majority of sectors like utilities.
What are we excluding? What's not in it?
So some of the big stocks that are not in it that people might be surprised. You've got things like Walmart. You've got things like Schwab. You've got IBM, General Electric. So some big companies.
I don't want to keep drilling into this, but can you tell us why, for example, Schwab was excluded? Is there some particular methodology or something like that? I know you vaguely mentioned methodology, but...
Yeah, so the funny thing was Schwab was actually excluded before they went to zero commissions. So people think that it was about zero commissions. It was actually not. It was done before the zero commission ETF trading. But the actual revenue growth has not been great. And in terms of one of the metrics we look at, which is the performance of the CEO, the stock price under the current CEO versus the market, it's underperformed. So that's the two major things against that.
I've got a question. And we were talking about this because we talk about what you're doing. And why wouldn't you be short stocks? Why couldn't you construct an ETF where you can actually get short those same names and give an investor... make a market neutral fund. You can make an argument that that's the beauty of what's going on in the evolution of the ETF world, is that the sophistication of a hedge fund can come right in a wrapper in an ETF.
Funny you should say that.
Oh, sounds like another release.
Oh no, I smell another ETF coming.
I think that that is definitely a more active strategy.
Right.
What we're doing, the problem is, we've got to try and be low cost. We've got to try and offer a solution that's buy and hold, that's value for money. And the problem with this shorting is it can be quite expensive to hold those positions, to borrow the stocks consistently over time. So we don't do that, but I agree with you. I think for a more active strategy, that could be a very interesting idea.
Okay, let me just end. I forgot to mention honorable mentions for interesting thematic ETFs this year. Goes to UFO, this Procure Space ETF. We had the head of that on. That was a lot of fun. I'm a total space nut. The Defiance 5G Next Gen Connectivity ETF, FIGG, 5G, very hot topic. That was interesting to me. The Cloud Computing ETF, CLOU, also another interesting one for me this year. And hopefully there's going to be more of those thematics coming next year for nerds like me. Oh, there was a nerd, NERD, the
NERD.
Sports ETF.
I was going to throw that one in.
I forgot that.
Will Hershey's NERD.
Thanks very much, guys. And that does it for this week's ETF Edge. I'm Bob Pisani. My thanks to Dave Nadig, Tim Seymour, and Will Rhind for joining us today. And thank you for watching. You can find all of our latest videos right here on our website, etfedge.cnbc.com. We'll see you next Monday. Have a good week.
Get the ABCs of ETFs with the ETF Edge newsletter, your weekly update on the hottest trends in the nearly $4 trillion market of exchange-traded funds, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.